Okay, let's talk a little bit about different order types. So with the previous videos, we talked a little bit about more in terms of just buying and selling. So the price has been there, and we've just taken the price that was given to us, and that's been fine. But there are times, of course, when we want to be a little bit more advanced in our trading, we perhaps don't want to buy until the price gets to a specific level, whether that's higher, whether that's lower. We also want to be able to limit our loss in a position. So once we're in a position, we want to be able to close that position should the value of the asset get to a certain point. So we kind of want to potentially limit our loss as much as we can. And similarly, once we're in the position as well, we may want to close the position for a profit should it move in our direction. So let's talk about all those different potential permutations using those three main order groups that we've got. So the first one is a market order. Now, a market order is basically saying, you know what, I just want to get in at any price. Okay, the current price may be 100 to 101. Let's use that as an example again. A nice and easy example, and we want to buy 1,000 CFDs. The current price is 101, and that is basically going to be what we get filled at. If there's 1,000 available at that price, and the broker will tell us or not, depending if we're trading something very, very thick like Tesco or Apple or Amazon or anything like that, no problem. If we're trading some little small oil explorer, the broker may well say, listen, you can't have it all at 101. You're going to have some at 101, some at 102, some at 103, some at 104. And you're going to get, because using a market order, it's basically saying any price available, just fill my order. So you've got to be careful when you're doing that, because you're basically completely leaving any price sensitivity out there. The market order ultimately says, I don't care about price, I just want to get in or I just want to get out. Fine on big things, indices, commodities, big stocks, like I say, but you've got to be a little bit careful on some of the thinner things, and you've got to be a little bit careful when the volatility is low on certain things. So just be cautious of that. I won't go into that too much depth here because it could be here for a while, but just be aware. Okay, limit order. Now you've got two ways of using a limit order. A limit order basically says, you know what, Mr. Broker, please execute this order at this price or better. Do not pay any more than this or any less if it's a sell order. So in other words, if I have a limit order in at 100 to buy, it's basically saying I do not want to pay a penny more than 100. I'm prepared to pay lower than that. Of course, if the market opens up at 99, I'm very happy to take that stock at 99. No problem at all. But I will not pay a penny more than 100. It's a limit. That's basically how it says. It's the limit of what you're prepared to pay. Now, you can use a limit in two ways. The first way you can use a limit is to say, I'm in no position at the moment, but you know what? If the stock is trading at, let's say it's trading at 110, right up here, 110 that is, and you say, you know what, that's a bit high. I like it though, but I want to wait for it to come down to here until I buy at 100. I'll put a limit order in to buy at 100 or whatever size you want. The stock then oscillates around, comes down. When it comes down to the 100, your limit in, you will get filled on the trade. If it never comes down and doesn't touch that 100, you will not get filled. So it's a kind of way of saying, I want to be involved, but only at a certain price. So that's the way that you can use it to get into a trade. Another way you can do it is you're already in the trade. Let's say you're already in a trade and you've bought it at 100 this time, but you don't want to be sitting on the screen and you just want to know that if that thing goes up to 110, you just want out of the position. So you would put a limit order to sell the amount of contracts that you are in at 100, and you're basically instructing the broker and saying to him, Mr. Broker, sir or madam, I would like to sell my position, my 100 share position, or my 1,000 my 100 CFD position, my 1,000 CFD position, but I do not want a penny less than 110, and so I'm leaving you with a limit order. Of course, this is all automated via a ticket. No one's ringing up brokers and saying that anymore in that manner. But you get my point. You're basically saying I don't want to pay a penny less than that. If it goes up and it gets to that level, then get me out of the position. Otherwise, let's leave it to run. So there's two ways of doing it. One to get in, one to get out. And similarly with stop. Now let's talk about stop loss order from a perspective of you're already in the trade. So let's use this example here we've got on the Euro US dollar. I'm not sure when I pulled this chart from. This one was from the archives by the look of the price. let's say you've gone long here, this little blue candle saying I've gone long here at 131.30, whatever that may be. A little bit small for us to see, but you get the idea. We're basically saying, you know what, if this price goes under this key level here, so we're doing a little bit of technical analysis, we'll do some of that later, but we basically decided that if the price of the euro US dollar goes to there, then we want to try and limit our loss by closing the position. So it's a stop loss position. It's basically saying, Mr. Broker Sir, if the price of euro US dollar does go there, then please sell me my order amount, my number of CFDs that I specify at the market. So in other words, what you're basically saying is that the level, instead of a limit where a limit you're saying it's got to be that price or better, or the stop, most of the time, there's a little caveat to that, and we'll cover that in a second, but most of the time you're basically saying, let's imagine that was 131, your stop was at 131, you're basically saying if the price hits 131, then put a market order to sell my position in. Now, why is that slightly different from a limit? Because that's basically saying just get me out of the position. So if the market suddenly rushes right through it, it triggers it, but there may be a delay between you getting filled and the price moving, so you might get a fill slightly lower. That's the price that you pay for using a stop market. You can use a stop limit just to confuse things even further, but don't get confused by it because it's very, very simple. It's still the same, but it's basically saying stop my loss, but do not pay less than 131. So in other words, it's a stop limit. In other words, a limit sell goes in at 131 if the price hits 131. Now obviously if the price is still at 131, you're going to get filled. If you're unlucky and the price has gone straight through it, by the time your order gets there, you're only going to be sitting there at 131 waiting. So the danger of that, as with any limit order, is that you will not get a fill. But the positive is that you will only get a fill at your price. So that's how a stop works. Now, generally speaking, most people use a stop market because, in the day, if that price goes to that level, you don't want to be in the thing. Yeah, you do not want to be involved in it. So you don't really care if you get slipped a little bit on a few ticks here and there. So that's that. Now, there's one more thing to add. If you want to get into a position, okay, and you may want to use a stop. But anyone was saying, well, how can you use a stop if you're going into position? Well, if you think of this, let's use this chart. It's a nice little graphic that we've got here we can work off. Let's look at this. So let's assume that you don't have any position here. Forget that buy order there, and forget that I've put loss there because you won't have a loss. So what do you want to do? Let's say, for example, you think, you know what, I want to go short on the euro US dollar, which is what this one is, but I only want to go short if it breaks under this level because I think that this is going to be the start of a big trend. If it holds here above it, I don't want to be short because for me it looks like the buyers are in control there. So I'm not going to touch it. However, if it goes under there, then I want to get in. So you're going to use a stop order to enter into the position. And remember, the stop basically says if this level is hit, fire an order to sell, if it's a sell stop, into the market for me. And because you've got no position already, what that's going to do is that's going to make you short, whatever size you've specified, at that level. So it's a way of getting involved in the market if you're not already involved and specifying a level that you want to enter the trade. So it's different from a limit because the price is coming up to it and you're fading. If you think about it as kind of fading or following the move, if it's pushing up to here and you've got a limit in, you can have a limit order to sell. That will get you into the market, but you're fading the move. You have a stop limit here, you're basically following the move. It's basically saying, okay, I want to sell it here, but it's going to give me a stop entry as opposed to a limit buy, which would get you long. So different ways of kind of looking at it and getting involved and using different order types to your advantage. So we've had a little look at that on a chart here. We've got a spread of a point. We've got 55, the last two digits, and 56. And this is kind of how we could do it if we're framing on this chart, which is a little bit bigger. We could have a buy limit here, and we could kind of nest these orders all together. Something else to kind of look at is that we can have a buy limit here at 1.1, and then that automatically triggers a subsequent set of orders for us, and brokers generally can do this for us. It's either you know, they've got different ways they label it, but it's normally very intuitive. So you buy here, then a sell stop automatically goes in here, and that's going to limit your loss potentially to that, although you could have slippage, so be aware it's not guaranteed unless you pay a premium for a guaranteed stop, which is something else you can do. And then a sell limit will go in here, which is basically saying that's the point you want to take profit. Now obviously if one of those gets triggered, you don't want to be left with that order in, because if that gets triggered, you're going to have a neutral position from the buy and still have a little sell stop sitting there. So you want to make sure that they are cancelling each other. They're generally denoted as OCO, which means one cancels the other, but just double check that is happening when you're placing those orders.